Hey guys, this is Highly the Credit Renovator. It's been a while since I posted a video, but I'm right back at you. And today I want to talk to you about credit card approval strategies and to tell you which banks pull from Experian, which pull from Equifax, and which pull from TransUnion. So check this out. Before you apply for your next credit card, you need to know this. Not every credit card company checks the same credit bureau. I'm sure you guys have seen other folks post this on the internet, and I'm always here to debunk the myths that you see on the internet. But this one is actually true. Some credit card companies pull exclusively from Experian. Some pull exclusively from Equifax. Many of them pull from TransUnion. Now, there are some that check all three. What you don't want to do is apply blindly, because we all know that too many inquiries can hurt your credit as in a credit card situation, as well as when automobile dealerships pull a lot of credit. So you don't want to risk a hard inquiry and apply for credit without a strategy. Now, as I'm talking about this, applying for credit and credit cards specifically, as I'm talking about here, is part of an overall strategy to build your credit. So we're not just going to blindly just open up credit trying to get a credit card so we can go out and spend it. We don't want to do that. We want to build credit so we can move on to bigger and better things. Like, obviously you want to drive a nicer car. We want to get a nice house because the home is a key part of building wealth. So we want to have the credit to be able to get the right kind of house. And you want to be smart about how you apply for credit, And again, this is just a strategy. We're not trying to trick any banks. We're not trying to do any hacks or anything like that. It's just understanding how they work will help us to, and help you to get a strategy for applying without and being able to get the kind of credit you want without just having inquiries all over the place. It's about understanding what the lenders may review prior to you applying for credit. Now, so if you know that, then you'll know which of your credit, because we all know that all three credit bureaus that we have, they're not the same. They're usually close, but in some cases, some of us have one bureau or another that's a lot stronger or weaker than the other two. And so if you know which banks are pulling from which bureaus, you can pick the one that will look at your best bureau, which increases your chances of getting a card and getting a good rate on it. And so you can lower your risk of getting denials and unnecessary inquiries, and you can make better credit decisions about who to apply with. So first, why bureau pulls matter. Remember, your credit profile is not the same across all three bureaus. One bureau may actually show a collection or some other derogatory account that doesn't show up on the other two. One bureau may show high utilization. The other one may not be updated yet. And again, if you haven't gone through those steps of cleaning up your credit and making sure all of that stuff has been addressed, then this is where you want to consider that. And so with that inequality, we want to know which is your strongest bureau, and so you want to apply with the banks that will look at your strongest bureau. Because remember, it's not just about your score. It's about what the lender sees when they open up your file. Now, the biggest mistake that people make is a lot of people will only check an app. If they got an app that only looks at one bureau, say they're using the three credit bureau apps, specifically Experian.com, Equifax.com, and TransUnion.com to monitor their credit. Well, they may only be looking at Experian because it was offered for free with one of their bank credit cards or some other bank free gift to be able to access your credit for free. So they're only looking at the free one. Or if they're looking at Credit Karma and they're only looking at TransUnion and Equifax and not getting Experian because they have to pay extra for that. So the big mistake is not checking all three bureaus. It's important to check all three. Just like on a car, you're going to check all four tires. So you don't want to ignore the other three because you're only worried about the front wheel, front driver's side. So again, back to the credit bureaus, you want to be able to look at all three so you know which one is is weak or strongest, and you can direct them that way. Now, the preference for me is to fix all three of them so they're all equally strong. But remember, if you're only looking at that one app, that one score may not be the score bureau that the bank uses if you don't know which is which. Okay, and so let me tell you a little bit about some of the common credit bureau pull patterns from some of the major banks. This is not all inclusive, and remember, what I'm telling you is as of this video, and it's always subject to change. But generally speaking, this will help you in a long way. And at the end of the video, you'll be able to see a link where you can get a PDF guide of all of this. So keep in mind too that the bureaus also vary by state, product, and application channel, but these are the common patterns. American Express, they usually pull exclusively with Experian, but they have been known to look elsewhere. Chase is usually Experian as well. Capital One, a lot of us out here that was a Capital One are our friends. Capital One typically looks at all three, so it's important that all three of your bureaus are strong and clean. That way, with Capital One, you got a really good chance of getting a card with them, and when it's particularly clean, you'll get a higher credit limit because they're always leery. Capital One's very friendly, but they do give levels for risk. So if you're risky, they may give you a card, but they may not give you a high limit. Bank of America, Experian for personal, TransUnion for business. A lot of my guys out there who got business credit, and you're looking for business credit, and you're looking for 0% interest credit cards, I can tell you more about that. They usually go Bank of America. Bank of America is very friendly to us entrepreneurs out here. Citibank, Experian, Equifax. Discover, they go to Experian or Equifax. Every now and then, from what I know, they go to TransUnion. Barclays, they usually go to TransUnion exclusively. Synchrony Bank, also TransUnion. Wells Fargo is usually Experian. And U.S. Bank, they vary by state because U.S. Bank is pretty national. They're all the way across the country, just like Chase. So they do vary from state to state for personal credit. Now, for business credit cards, they typically go exclusively with TransUnion. So those are just some of the regular ones. I got a more complete list with some others as well. And again, there'll be a link to go to get a PDF with a list of all of that in a guide. So if you want to look more. Now keep in mind, this list is not exhaustive, and of course there's other ones as well. But there is a strategy that you want to have before you apply for any credit, specifically in this case, credit cards we're talking about. So number one, pull all three credit reports, just like I talked about earlier. So you want to look at all three credit accounts. Now, if you want the ability to pull all three in one place, I recommend Smart Credit. I'll post my link in the description below as well. If you want to have the ability to pull your credit, all three bureaus with Smart Credit, and on a 7-day trial, only costs you $6. You'll be able to look at all three in an easy to read format so that you can get a good strategy for getting more credit. Secondly, you want to check for collections, late payments, charge-offs, inaccurate balances, and all of that other negative stuff that you've heard me talk about before. Because before you apply for new credit, it's always a good idea to clean up any negative stuff, because even if your score is good enough to get their interest for a card, they may deny you, or again, even just as bad, give you a really low credit limit, because if they see you've had issues with past credit card accounts that went into collections, delinquencies of a kind, and so they don't want to trust you with a lot of credit right away. So it's better to check that stuff and clean it up beforehand. And especially, you want to make sure that your credit utilizations on your current cards are low. Of course, many of you are aware of the 30% maximum credit utilization. So that's 30% of your total available credit per each account. Don't lump them together. You want to manage these individually. And so although 30% is the max that you can have without getting penalized, I recommend 15 to 20% of your credit limit. That's the sweet spot that'll get you credit with just about anybody. So that's a good first step. And another little secret, that when you maintain that 10%, that 15 to 20% utilization, it's more likely that your existing credit card companies are going to give you increases on the cards you already got. So the only thing better than being able to go out and get more credit is being able to get more credit from the people you're already dealing with. Let's strengthen those relationships. You hear me talk about that a lot as well. But here's one thing. This is something you don't want to do if you're thinking about applying for a mortgage within the next 30 days or so. With any mortgage situation, you don't want to be applying for any new credit right before you're trying to get a mortgage to buy your house. So this is something you want to do when you've either got that covered or it's not in your immediate future. Here's another thing a lot of folks don't know. If you're thinking about any one of these credit card companies that I mentioned, so you say you found the one that's right for you, they pull from a bureau that's one of your strongest, so you know everything on that bureau is clean and you got a high chance of getting an approval with them. Do one more thing. Go to that website first. There's usually somewhere in the website at the bottom, or maybe even in the body of it, where you can click a button and they'll almost pre-approve you, or they'll give you a sort of a description of what they're looking for in a good applicant, or even better, they'll tell you some of the things that you can't have that will get you a denial. So you can look and be able to determine whether it's a good fit for you and that it's a high chance that you're going to get an approval from that lender without them actually pulling anything. So you want to, this will allow you to match that card's requirements for a customer with your profile. And then lastly, don't apply just because the card sounds good, or it's one that, obviously we want the ones, we care about brands, but it's really about what the card offers you in terms of benefits that match with your use. Because if you get a credit card that gives you a lot of airline miles, but you're not somebody that flies, it's kind of pointless, right? If you get a card that offers you cash back from, say, some sort of service or product that you don't use, you don't want to get that card. You want to match what they offer and what they're tied to what works for you. So, because the goal is not just to get a card. The goal is to use the card and get the card and use it to build your credit profile, so that when you're going to do things like get an automobile or get a mortgage or any other, or business loan, any of those things, you want to build a profile that makes lenders always want to say yes. And so here's some examples of application strategies. All right. And so say you got an Experian problem. Okay. So your Experian credit report has 2 collections, but your TransUnion is clean. So obviously you want to lean more towards the lenders who look primarily at TransUnion, or exclusively with TransUnion, or primarily with TransUnion. And you want to avoid any of the ones who obviously look at Experian. So that way you don't expose yourself to a potential denial. Example number 2, Capital One. So the reality with Capital One, they're known for pulling all 3. So if only one of your reports is clean, you might not want to apply with Capital One just yet. Now, sometimes Business Insider, a magazine that I read, it's a trade publication. I read all the boring stuff and share it with you guys, so you don't have to. They note that specifically with Capital One, the fact that they're known to pull all 3, and American Express and Chase rely heavily on Experian, then you would want to avoid using Capital One and maybe lean more towards American Express or Chase, assuming you meet their profiles as well. Now, if you're a mortgage-bound client and you're trying to buy a house soon, you don't want new inquiries and new accounts that will affect your mortgage profile in a negative way. So don't go out and be applying, like I said before, if you're thinking about a mortgage in the near future, and let a $300 credit card cost you a mortgage, or even worse, having you push back or cost you on your DTI as well. That's debt to income ratio for you folks out there that are not familiar with that. That's where they take all your bills and divide it by your gross qualifying income to determine whether you can afford a mortgage or not, or how much you can afford. So you might be wondering, what builds a better approval profile? So what do I want my credit profile to look like to ensure or give me the best chance of getting approval on a credit card? So what lenders want to see in all situations, they want to see stable payment history. So obviously, if you're trying to get a new credit card, you want to make sure your pay history on your current credit card is clean. You don't have late pays, certainly not missed payments, but late payments, not 30s, not even 30s, 60s, or 90s. You want to have that low utilization that I was talking about, because the beautiful thing about that, if you show a history of keeping your balances low and not maxing out your cards or running it up, they're going to extend you credit, not being worried little about you maxing out the card, because they know statistically, if you max out your card, that's usually the first step towards default. So you don't want to have that. They look for the inquiry. So if you're applying with them and they're looking to see if you've been applying with other people. A big red flag for lenders is when they see you're shopping around, especially in the credit card area, because they're worried that you're opening too many cards at one time and putting yourself setting yourself up for fail and making you a high risk for them. And not having unresolved derogatories, collections, charge-off. You want to make sure you don't have those. That definitely will help you out. You want to have consistent income. That doesn't show up on credit, but in a full application, if they do income, some credit cards do ask for income verification, but you want to be clear on that. You want to have a reasonable debt load. I talked about debt to income ratio before. So they like to see, just based on what's on credit, not even counting non-credit stuff, that you don't have a lot of what looks like to be like a lot of debt. And then, of course, they love to see, this is non-specific, but they want to see a report that looks clean, current, and believable. Not because at the end of the day, you don't want a credit profile where you look desperate to get new credit. You want one that looks like discipline, that looks like I'm a person that manages my credit, I don't overly rely on credit, and I don't have any issues managing credit. So that's pretty much it. So those are the things you want to consider, and those are the actions you want to go and take before you apply for credit. Don't just apply all over the place. Make sure you have a strategy. Now, I created a credit card bureau guide, pulling guide, that breaks down a lot of what I talked about here. You'll see a link for it, and if you want, you can click that link, and then you can get a copy of that and use it as a reference. But just always remember, it's not permanent. It can always change, but they don't change much. One thing you'll learn about creditors is once they find a good pattern for finding customers, engaging customers, they don't usually change much unless a problem drops up. So remember, overall, getting new credit requires better credit. And better credit is not just about higher scores. It's about access, affordability, and options. So when you understand how lenders review your profile and you stop applying emotionally and start applying strategically, you will get your credit built up, you will get the credit you want, and you will not incur a lot of inquiries in the process of building your credit. So if you like this video, subscribe for more strategies and you'll get a notification every time I roll out these videos. I'm getting back to my at least one video a week. I will be posting videos on hot button issues as they come about. But if you click the link below, and you'll be able to download the guide that I'm referencing in this talk. And so that along with this and other credit, you can apply smart and get your success of approvals before your next hard inquiry. So you'll get an approval with that inquiry. All right, talk to you guys on the next video. Have fun.